Hello everyone, you're very welcome back to the channel. Today we're going to be answering the question, what is the best all-world ETF for European investors? All-world ETFs allow you to invest in the global equity markets with one convenient and cost-effective investment. By investing in an all-world ETF, you'll gain exposure to companies operating in developed markets like the United States and Europe, while also gaining exposure to companies operating in emerging markets like China, India, and Taiwan. The ETFs that we'll cover in this video will provide exposure to one of four indexes: the MSCI World Index, the MSCI ACWI Index, the FTSE All-World Index, and the FTSE All-World High Dividend Yield Index. For each ETF, I'll highlight the ETF's total expense ratio, the ETF's domicile, the structure of the ETF's dividend status, and the European brokerage platforms that the ETF is available on. If after watching this video you want to get started investing in all-world ETFs but you don't have a brokerage account, you can try out brokers like DeGiro, BookZero, Trade Republic, or Trading 212 using the links in the video description. If you want to learn which of these brokers is the best for European investors, check out the video popping up on screen after this one. Before we jump into the ETFs, I want to discuss the four all-world indexes which are covered by the ETFs on our list. First up is the MSCI World Index. The MSCI World Index is made up of 1,508 companies spanning 23 developed countries. In each of these 23 markets, 85% of the total market value is covered by the index. So by investing in an MSCI World Index fund, you're investing in a fund that is representative of the global developed equity market as a whole. The index has a dividend yield of 2.09% and as at 31st of January 2023 has a total market cap of $53 trillion. The top 10 companies in the index are Apple, Microsoft, Amazon, Alphabet Class A and C, Nvidia, Exxon, United Health, Tesla, and Johnson & Johnson. These companies account for 15.91% of the total value of the index. Next up is the MSCI ACWI Index. The MSCI ACWI Index is made up of 2,882 companies spanning 23 developed countries and 24 emerging market countries. So right away you can see that the difference between the MSCI ACWI Index and the MSCI World Index is that the MSCI ACWI Index also provides exposure to the emerging markets. Many investors would consider this index to be more representative of the global equity markets as a whole. The index has a dividend yield of 2.21% and as at 31st of January 2023 has a total market cap of $60 trillion. The top 10 companies in the index are the exact same as the MSCI World Index, albeit with a lower total weighting of 14.11%. Then we have the FTSE All-World Index. The FTSE All-World Index is made up of 4,147 companies spanning 49 markets, including both developed markets and emerging markets. If the MSCI ACWI Index is to be considered as representative of the global equity markets, then the FTSE All-World Index should be considered as the global equity market, period. It covers 98% of the world's investable market cap. The FTSE All-World Index contains 1,265 more companies than the MSCI ACWI Index. The index has a dividend yield of 2.26%. FTSE doesn't disclose the total market cap of the index in the fact sheet. Finally, we have the FTSE All-World High Dividend Yield Index. The FTSE All-World High Dividend Yield Index is made up of 1,874 companies spanning 49 markets, including both developed markets and emerging markets. Unsurprisingly, the index has a dividend yield of 4.04%, which is much higher than the other three indexes, albeit at the cost of less diversification and coverage. The top 10 companies in the index are Exxon, Johnson & Johnson, JP Morgan, Chevron, Procter & Gamble, Home Depot, Nestle, Merck & Co, AbbVie, and Pfizer. These companies account for 13.24% of the total value of the index. As I mentioned in the previous episode of this series covering emerging market ETFs, due to the sheer size of the all-world index and the number of companies, many if not all world ETFs will use what's known as optimized sampling to provide you, the investor, with the index return. I'll repeat my explanation of this again here. The likes of S&P 500 ETFs always use what's known as full replication to provide investors with the return of the S&P 500 index. Full replication is where the ETF owns every stock in the S&P 500 in the exact same proportions as the index itself, which is what you'd expect from an index fund. However, when it comes to all world indexes, indexes, this isn't always possible nor desirable. Stock market indexes show the stock performance of a collection of company stocks over a period of time. The performance of the index does not account for the trading fees, among other costs, that are incurred by ETFs when buying and selling shares to mimic the index. So if an ETF is to provide investors with the index return, then the ETF needs to minimize cost insofar as possible. Consider the smallest of companies in markets like the Philippines, which are included in the All-World Index. They're so small that even their bankruptcy would have a negligible effect on the index itself. Shares in these companies wouldn't be very liquid, meaning there wouldn't be a lot of trading activity. That can make the shares expensive to buy. So the ETF needs to decide whether the expenses associated with buying the shares is worth the additional tracking accuracy to the index. In many cases, it's not, and the ETF will either exclude the stock or replace it with a highly correlated but cheaper alternative. The goal here is to minimize cost while also accurately reflecting the proportionate return delivered by each stock in the index, so that the ETF ends up delivering more accurate index tracking than full replication would. This is because full replication for an all-world index would come at a high cost, which in turn would result in returns that deviate from the index. That's the purpose of optimized sampling. The downside of optimized sampling is that it can produce results that deviate from the index, for better or worse. These are known as tracking errors, and the elimination of tracking errors is one of the primary use cases for synthetic ETFs over physical ETFs. You can check out the video popping up on screen after this one to learn more about synthetic ETFs. Alright, let's kick things off with ETFs that track the MSCI World Index. First up is the SPDR MSCI World UCITS ETF, ticker symbol SWRD. The ISIN for this ETF is IE00BFY0GT14. The expense ratio for this ETF is 0.12% or 12 basis points, meaning for every €1,000 invested, €1.20 will go to fees. SWRD is domiciled in Ireland and is structured as a physical ETF, meaning the ETF actually owns the underlying stock investments. The ETF is an accumulating ETF, meaning any dividends received by the ETF from the underlying stocks will be reinvested rather than paid out to the ETF shareholders. SWRD is available on DEGIRO, Trade Republic and Trading 212, but not Book Zero. Next up is the Xtrackers MSCI World UCITS ETF 1D, ticker symbol XDWL. The ISIN for this ETF is IE00BK1PV551. The expense ratio for this ETF is 0.12% or 12 basis points. XDWL is domiciled in Ireland and is structured as a physical ETF. The ETF is a distributing ETF, meaning any dividends received by the ETF from the underlying stocks will be distributed to the ETF shareholders rather than being reinvested. Dividends are paid out on a quarterly basis. XDWL is available on DEGIRO and Trade Republic, but not Trading 212 or Book Zero. Finally, we have the Invesco MSCI World UCITS ETF, ticker symbol MXWS. The ISIN for this ETF is IE00B60SX394. The expense ratio for this ETF is 0.19% or 19 basis points. MXWS is domiciled in Ireland. The reason why I'm including this ETF is because it's structured as a synthetic ETF, meaning the ETF artificially provides exposure to the index return through the use of total return swaps. Again, I would highly recommend checking out my full video explaining synthetic ETFs, but I'll give you the short summary as to why the higher total expense ratio could be worth it. Firstly, given the nature of synthetic ETFs and how they operate, the Invesco ETF will very likely provide investors with a more accurate index return as compared to physical all-world ETFs. That's the first part of the rationale. Secondly, synthetic ETFs have tax advantages over physical ETFs, namely an exemption from US dividend withholding tax, which results in synthetic ETFs earning 15% more dividends from US stocks. Synthetic ETFs also save money on tax when trading UK, French, and Italian company stocks. Given that US companies account for 67.5% of the Invesco ETF and UK companies account for 4%, there could very well be a material tax advantage in favor of the synthetic ETF. The question is whether the benefits of the tax advantages and the higher tracking accuracy outweigh the higher total expense ratio. The fund fact sheet says that there is no swap fee. However, given the opaque nature of synthetic ETFs, there may be some additional cost to consider due to the use of swaps. Nonetheless, I'm of the belief that most ETF investors should stick with physical ETFs due to the inherent complexities of synthetic ETFs and the additional personal risk factors. MXWS is an accumulating ETF. MXWS is available on DEGIRO, Trade Republic and Trading 212, but not Book 0. Next up are ETFs which track the MSCI ACWI Index. The only real choice here is the iShares MSCI ACWI UCITS ETF, ticker symbol SSAC. The ISIN for this ETF is IE00B6OR52259. The expense ratio for this ETF is 0.20% or 20 basis points. SSAC is domiciled in Ireland and is structured as a physical ETF. The ETF is an accumulating ETF. SSAC is available on DEGIRO, Trade Republic and Trading 212, but not Book 0. This ETF is really just an alternative to the MSCI World Index, where you want to have emerging markets exposure as well as developed market exposure. However, an important point to consider is whether or not the additional cost is worth the additional coverage, considering the MSCI ACWI Index is also predominantly made up of US companies like the MSCI World Index. The weighting of US stocks in the indexes is 60.02% and 67.68% respectively. Next up are ETFs which track the FTSE All-World Index. Vanguard offers two such ETFs, the first of which is the Vanguard FTSE All-World UCITS ETF USD Accumulating, ticker symbol VWCE. The ISIN for this ETF is IE00BK5BQT80. The expense ratio for this ETF is 0.22% or 22 basis points. VWCE is domiciled in Ireland and is structured as a physical ETF. The ETF is an accumulating ETF. VWCE is available on DEGIRO, Trade Republic, Trading 212 and Book 0. The second Vanguard ETF is the Vanguard FTSE All-World UCITS ETF Distributing, ticker symbol VWRL. The ISIN for this ETF is IE00B3ORBWM25. The only difference between VWRL and VWCE is that VWRL is distributing. Dividends are distributed on a quarterly basis. VWRL is available on DEGIRO, Trade Republic, Trading 212 and Book 0. These funds are best suited to investors who want to own as much of the global equity market as possible with one single investment. As I said, the FTSE All-World Index contains 1,265 more companies than the MSCI ACWI Index. But remember, the exposure to US companies is still disproportionately high relative to other markets, standing at 58.8% compared to the MSCI ACWI Index's weighting of 60.02%, and that's with 1,265 extra companies. So it's just about weighing up the benefits of extra coverage against the drawbacks of higher total expense ratios. Last but not least, we have ETFs which track the FTSE All-World High Dividend Yield Index. Once again, Vanguard offers two such ETFs, the first of which is the Vanguard FTSE All-World High Dividend Yield UCITS ETF Accumulating, ticker symbol VGWE. The ISIN for this ETF is IE00BK5BR626. The expense ratio for this ETF is 0.29% or 29 basis points. VGWE is domiciled in Ireland and is structured as a physical ETF. The ETF is an accumulating ETF. VGWE is available on DEGIRO, Trade Republic and Trading 212, but not Book 0. The second Vanguard ETF is the Vanguard FTSE All-World High Dividend Yield UCITS ETF Distributing, ticker symbol VHYL. The ISIN for this ETF is IE00B8GKDB10. The only difference between VHYL and VGWE is that VHYL is distributing. Dividends are distributed on a quarterly basis. VHYL is available on DEGIRO, Trade Republic, Trading 212 and Book 0. These funds are best suited to investors who want exposure to global equities while also prioritizing dividend yield. So with all of that being said, what is the best all-world ETF for Europeans? The first thing I'll say is that I don't personally own an all-world ETF. I own an S&P 500 ETF, an emerging markets ETF and a developed Europe ETF. Now you might be asking, why wouldn't you just own a single all-world ETF instead of owning 3 ETFs which in totality cover the global equity markets? The answer is that I like to have the ability to control how much capital is allocated to each market at any given point in time. For example, for most all-world ETFs, anywhere between 60 and 65% of the fund's value will be accounted for by S&P 500 company stocks. So when you invest in an all-world ETF, most of your invested capital is going to be allocated towards the US. But what if you wanted more exposure to the emerging markets and Europe? What if you wanted to reduce your exposure to to US equities. With all-world ETFs, you don't have that level of control, and that's why I like to own each of the component markets separately. However, for those who do want to own an all-world ETF, it is challenging to pick an outright winner because each of these ETFs have their own merits, and some investors will value certain merits more than others. SWRD and XDWL have the lowest total expense ratios for all-world ETFs, sitting at 12 basis points. However, these ETFs track the MSCI World Index, which does not provide exposure to emerging markets. Do you want the lowest total expense ratio at the cost of having no exposure to emerging markets? If emerging markets aren't a priority, then there's also a case to be made for MXWS. This is provided that A, you're willing to do the necessary research to understand synthetic ETFs, and B, that the tax advantages and higher tracking accuracy of the ETF outweigh the higher total expense ratio and other additional costs in practice, which they may or may not. If you're looking for a true all-world ETF, then the likes of SSAC and VWCE might be best for you. SSAC has a lower total expense ratio of 20 basis points, but it tracks the MSCI ACWI Index, which contains 1,265 fewer companies than the FTSE All-World Index. VWCE has a slightly higher total expense ratio of 22 basis points, but you're getting exposure to 98% of the global equity market. Remember, all of these funds, with the exception of MXWS, use optimized sampling strategies. This means that the extent of your exposure to each of these additional companies will likely vary. So whenever you're paying a higher price for additional coverage, you really need to be sure that it's worth it. Finally, I don't think the all-world high dividend yield ETFs are worth the 29 basis points in total expense ratio. Yes, you're getting a higher dividend yield, but you're also excluding thousands of global equities which don't pay a dividend, and you're going to miss out on all of the capital appreciation associated with those stocks. Perhaps if you were approaching retirement and were looking to build up a passive income stream, or if the ETF was to be housed in a tax-free account, then it could be a viable option. So now that you know the best all-world ETFs for Europeans, you might want to get started with investing. Again, if you don't have a brokerage account or you want to try out a new broker, you can sign up to DeGiro, BookZero, Trade Republic, or Trading 212 using the links in the video description. Using these links supports me as a creator and lets me know that you found this video to be useful. What all-world ETF do you think is best for European investors? Have I missed any contenders for the #1 spot? If so, let me know in the comments. Thanks very much for watching, and I'll see you soon.